Hello, and welcome to another edition of the podcast called The Goldman Guide. We hope you're well and trust that the recent stock market performance has left you pleased. We've got some real teachable moments here, along with our market perspective and predictions. Our featured stock jumped over 14% last week to a new 52-week high, and we have another cool story to share with you today as well. As usual, we'll do our best to keep this week's podcast capped at 10 minutes or less. Let's start with a quick look at some key numbers and also introduce new metrics that are very important right now. Last week's market performance was quite good, to say the least, despite a few leading companies experiencing rough financial reporting. Specifically, I'm speaking about Intel, which we predicted would happen actually, and it dropped by about 10%. But since there were no scary forecasts and numbers were generally decent for all of the companies that were reporting by and large, the herd is decidedly bullish. It seems as if they're comfortable throwing caution to the wind. And that's okay. Years ago, when the market had a strong January, it was led by dreams. Small firms that had big aspirations and appeared set for great things ahead. Now, it didn't always hold true for the market, and today the performance is led by the absence of doomsday for stocks and the economy. A decent quarter is viewed favorably. In either case, a strong January often previews an up year. And the bigger, the better. Speaking of up, year-to-date the Russell is up 8.5%, which is great for us small and microcap stock lovers. But who could have predicted an 11% jump in the NASDAQ composite? It's amazing. We just have a couple days left in the month, trading-wise. It seems like this index could end the month up double digits, and that's just wild. For you bulls, there's good news underlying all of this. The 12-month forward PEs for major indices across the board are not really that high. They're not in the nosebleed range yet. And the RSIs, perhaps reflecting recent performances, are also still in a good bullish range. Now, the put-to-call ratio, a metric we haven't mentioned here before, is at its most bullish point in many months. It closed on Friday at 0.51, which is a very, very bullish figure. Anything at 0.7 or below, in fact, is bullish. At 0.7, the ratio is telling us that puts are being purchased at a rate of 0.7 for every call. That typically confirms that in the near term, investors are bullish. Also, the fact that the NASDAQ is up only 6% or so from its low, despite the big gains this month, and are still underwater just a tad on its 200-day moving average, these are also bullish signals, everyone, indicating the index's components are probably not grossly overbought either. And the AAII and ICI data, which have been consistently positive of late, are also check marks in the positive category. So against this bullish backdrop, we have what is probably the most important earnings week of the entire season. 671 firms are reporting, including over 200 on Thursday alone. On Thursday, we've got Amazon, Eli Lilly, Starbucks, Bristol Myers, Alphabet, Merck, and Ford. And earlier this week, we've got Exxon, GM, Pfizer, Pulte Homes, and a whole bunch of others. We're really covering some of the largest, most widely held stocks and those that are core representative leaders of their respective industries. Now, I suspect that we'll do well early in the week, stock-wise, market-wise, and when Thursday hits, we'll hit some nerves, but if last week was any indication, we might have a small repeat of the performance during earnings week. Maybe not to the same degree or magnitude, but still, this potential outcome is important to recognize. Okay, if you kind of slept through the last few minutes, I understand. Goldman says bullish stocks are bullish, blah, blah, blah. We know, and that's okay. Now's the time, however, when the rubber meets the road. Once the reporting season's over, I think the market could begin its declines, and in earnest. Why? Well, there will likely be no material news on the corporate front for stocks, and a flurry of economic news, leaving investors in a what now mode. So what do? How do we interpret it? We know these year-to-date index performances and stock performances aren't going to last forever. And I really believe that during or just after mid-February, we could see our first really tough days. We've talked about it the past couple of weeks, but now it seems more likely than ever. And that's why you need to prepare your portfolio. And even if you don't make the moves yet, be prepared mentally. How? The VIX. The VIX is a volatility index which trades on the CBOE and typically has an inverse relationship with the performance of the S&P 500 index. This means when things are going well, the VIX performs poorly. When things are going south and volatility ensues, the VIX shines. It's not meant to be a long-term investment. Think of it as a trade or an interim step. You can do it by buying VXX, that's Victor X-Ray X-Ray, which is actually the iPath Series B S&P 500 VIX short-term futures. I know it's a mouthful. That's why it's an ETN, which has characteristics similar to an ETF. Now, I chose this as an example for a couple of reasons, primarily because it has liquidity and trades millions daily. Now, it closed up at 11:30 on Friday, up from a recent low of 11:06, but that's far below the 4165 year high. The VIX, by the way, is considered to be an index that is a good entry point between the $15 and $18 range, as it may indicate an overbought or too bullish status in the market. It's at 1851 now, so the pricing is starting to get attractive. Now, this is for information purposes only, of course, and you may wish to wait a bit before dipping your toes in the water. I hate to use this analogy, but it kind of makes sense. Think of holding VXX or an option, buying a put or selling a call on the VIX, as a short-term insurance for your portfolio. Having a presence in situations like VXX, where the market could be overbought, could be a good play. Now, this thing is volatile as hell, so please have a short-term holding period in mind. There are other ETFs and ETNs of this type, and we'll probably introduce those another day. Okay, enough of the market. It's time for our featured stock of the week. And by the way, although it ran up 14% to the new high last week, we still like INSE and think it has 25% upside still left in it. Today's featured stock also has some really strong upside. I should tell you that we have a bit of a history with it. My research team and I covered it more than 25 years ago, and we had them present at investor conferences I hosted. Glad it has performed so well over the years. They've really grown both organically and through a series of M&A. Now, it doesn't have the liquidity or support that INSE offers, but it offers solid upside and trades at a market cap of over $800 million. The name of the company is Magic Software Enterprises Limited. Trades on NASDAQ and the ticker symbol is MGIC. It closed at 1610 on Friday. Now, Magic's a global provider of end-to-end integration and application development platforms and solutions and IT consulting services. As you can infer from my familiarity with the company, Magic's been around for more than 30 years. In addition to its technology, Magic boasts customers in over 50 countries. They've got 24 global offices, more than 2,000 employees, 1,300 global partners, including distributors and so forth, and they have millions of users worldwide. So, some key stats for you in a moment, but I have to tell you this one very important fact. This underfollowed stock hit a bunch of records in its financial performance for the third quarter, and that bodes very well for Q4 in 2023. The stock's about 5% below its 200-day moving average, but we believe that breaking through it is just a formality, and then it can really run. Maybe it even happens when they report next month. Our price target, as you can see, is $21, which is about 18 times the projected EPS of $1.18 for 2023, and that's on projected sales of $612 million for the year, which, by the way, is only 1.3 times sales, which is a pittance for a software company. And by the way, an 18 multiple on current year earnings for 2023, I think that ended up maybe coming out on the low side, given it's a software company and they trade at market multiples that are much higher. All right, that will do it for this week's edition of the Goldman Guide, and we hit our 10-minute target with plenty of time to spare. Thanks for listening, and we hope you enjoyed our info and ideas. Have a great week. Until next time.